Welcome to the lecture on analysis of break-even time and dual break-even points. So, we will talk about the break-even time and also the dual break-even point analysis in which you have 2 points of break-even. Now, many a times when we talk about, so we have talked about the break-even analysis in terms of break-even quantity. So, that much so what will be the production quantity, and at that particular quantity of production we assume that there will be break even. Now, there may be a situation when you are interested to know the time at which this break even will occur, and certainly that will depend upon what is the production rate. So, if you know the production rate, in that case you can predict the break even point, and the time in that case will be, so it will be expressed in terms of break even time. So, what happens that so when we try to define, it is basically the time required to produce that much amount, and if suppose you have Q is the production rate. So, if Q is production rate, so in that case that if T is the time to produce that size, so your Q will be QT. So, in that case T will be the break even time which will be of interest to know, that will be time, I mean assuming that the production rate will be constant for that particular time. But then there may be other cases that we will discuss also about the delay in selling, and in that case there will be time lag when it is produced, and then there is, because anyway you are getting the money only after it is sold. So, you have may have a time lag. So, that also we will discuss. Now, we can just see one example, that suppose somebody has a home business, and they are producing a doll, dolls they are producing, and so doll producing company is there, and they have the costs, and they have variable cost. So, variable cost is $20 per unit. So, per doll they are having the $20 of variable cost, and fixed cost is $300. That is your fixed cost. Now, selling price of the doll, selling price per unit of doll is $50. So, this is the data which is there for the company. So, as we have studied. Now, in this case we know that we can have the break even quantity, and we know that break even quantity will be or point will be FC by P minus V. So, you have 300 and your P is 50 and V is 20. So, it is around 10 units. So, that is 10 units is the break even quantity, but if you try to find the break even time, and if you know that if the company can produce 2 dolls a day, then what will be the break even time? So, in that case break even time will be 10 by 2. So, it will be 5 days. So, if the production rate is assumed to be fixed, in that case after 5 days the company will reach at a break even stage, when the company has neither profit nor loss. Now, the thing is that what we discussed, that in reality we assume that in reality basically it cannot be assumed that it will be always same. There may be, so when you are producing and then it will go to market and then it will be sold. So, only after selling you are getting the income. So, then only you can say that now you have to compare with this cost line, and then you can come to a point of break even, where there will be R and the total cost will be same, or the revenue line and the total cost line will be meeting. So, basically there are a factor, that is your time lag. Now, in the normal case, what we have seen, that your R becomes P into Q into T. So, that is what, because R is nothing but P into Q. So, P is your price per unit and Q is the quantity produced. Now, this is as this Q is QT. So, Q has become QT. So, R will be PQT. Now, if you talk about the time lag. So, in case of time lag, so if there is a in case of time lag, so if that is denoted by TL. So, that is basically the time difference between the point or the time when it is produced and the time when it is sold. So, that is your TL, it is the time lag. So, if you define this time lag and if you keep that into the loop, then what we can write, this R basically will be PQ into T minus TL. So, basically that will be your time lag. So, so because of this time lag, your revenue equation will be coming like this, because your revenue will come only once the product is sold. So that time lag, this TL has to be subtracted from that T. Now, in that case, if you see that if your cost line and the revenue line has to be increased, I mean are to be equated, in that case this cost, which will be fixed cost plus variable cost. So, variable cost will be VQT and R will be PQ into T minus TL. So, you can write further. So, FC plus VQT, it will be PQT minus PQTL. So, you can further write. So, from here you can come, if you do certain analysis, you will get this equation for this T as FC plus VQ PQTL and divided by Q into P minus V. So, that is how this break even time will be expressed in terms of fixed cost, the unit price of the product, then the Q is the production rate, TL is the time lag, and then you have V as the variable cost per unit. So, you can express in such cases, whenever you have the situations of these time lags, in those cases you will have the you can find these values of these time, this break even time as as the function of all these components of the break even analysis, and you can find this time in case of there is there is time lag, I mean in such cases. Now, we are going to discuss. So, you can solve the problems, you may be having the data and you will be told to solve such problems where the time lag will be given. So, you can simply fit those time lag values into the equation and you can get the break even time. So, that way you can solve such problems. Now, we will discuss about another important terminology, that is your dual break even points. Now, what is that dual break even point? Because we have studied about something where we assumed that the total cost line or the revenue line or the income line they all are straight lines, but that may not be the actual cases. These lines may be non-linear, they may not be necessarily, they are not necessarily linear, especially the the revenue lines. So, in those cases they are since they are linear, they are assumed to be linear. So, they are cutting each other at one point, which is the point where the two things are same, and that is why we are telling that there is one break even point. But if they are of different shape, in that case if they are cutting at two places, then that is a case of dual break even analysis, dual break even point. And in that case you will have two lines basically. So, if you have some situations like if you have a total cost line goes like this, and if your the the revenue line goes like this. So, what you see that you have two lines, one line is here, one region is here, another region is here. So, this region, and this is your profit, and this is your so that way, and this is the cost, which is, so this is the cost line and this is your income line. So, that is your revenue generated TR, and this is your TC. So, this is cost, and this is the cost, and this is your profit. Now, so cost and R will be like this, and you have quantity here in these cases. Now, what we see that under such cases you have this point is known as the lower break even point, and this is known as the upper break even point. So, lower break even quantity or upper break even quantity, that may be defined as, and you can have a point where you have maximum profit, and at maximum profit what you see, you can say that this is maximum profit point is the one where your slope is 0. So, that way you can have this point also. Now, let us say, so this is the example of these dual break even points. Now, you can have an example. Suppose this line of the revenue which is generated, it is basically not linear, it is minus 2q square plus 86q, and your cost line is 16q plus 140. Cost line is a straight line, and this is not a straight line. Now, in that case we know that we find this profit as R minus C. So, profit will be R minus C. So, you have to subtract this R minus C. So, it will be minus 2q square plus 86q minus 16q. So, it will be plus 70q and minus 140. So, that will be your profit line, and we know that the break even points can be calculated by equating this profit to be 0. So, once we equate this profit to be 0, in that case for break even quantity your profit has to be 0. So, this will imply that 2q square minus 70q plus 140 will be equal to 0. So, that way you have two values of q. This is a quadratic equation in q. So, you will have two values of q, and q will be found as so you can find now it can further be written as q square minus 35q plus 70 equal to 0. So, q will be minus b. So, that is 35 plus minus b square minus 4 ac. So, 1225 minus 280 by 2. So, that way you will have 35 plus minus it will be under root, and it will be basically 945 and divided by 2. So, it will be something like 30.75 or so. So, if you calculate these values, this will be you have two values, one is 2.13 and another is 32.87. So, this is these are the two values, q 1 and 2 are these values. So, it will be 30 something like 30.75. So, once you do that you will get these two values. Now, what you see that, so that is why you have q 1 here and you have q 2 here. Now, after that, so in this region you are likely to get the profit, and then after this region you are likely to get the losses. So, that is the essence of these type of curves where you are getting these values. Now, the maximum value of these profits you have to get, and that will be minus b by 2a. So, the maximum value can be found, and this can also be found by taking the derivative of this line with respect to q, and that equated to 0. So, if you take the derivative of this equal to 0, so it will be 2 q minus 35, that will be that is will be equal to 0. So, for that the q value comes out. So, q for that the vertex. So, this is the vertex point, and q vertex basically will be nothing but this will be its derivative. So, it will be 35 by 2. So, it will be 17.5. So, this is the point which is having q as 17.5 here, and then you can find the maximum profit. Once you get this point, then you can have the point of maximum so profit. So, maximum profit which can be obtained will be by taking this value into the profit equation. So, if you take that profit equation, it will be, so maximum profit maximum will be minus 2 into q square. So, it will be 306.25, and then you have plus 70 into 17.5 minus 140. So, if you calculate these values, you will be getting 472.50. So, that is how you can calculate the value of the maximum profit in the case of these dual break-even points, and we must understand how to analyze these dual break-even cases where you have two break-even points. As you know that towards the left hand side of the lower break-even point, you have the total cost line is above the revenue line. So, again you have the loss case, and here also it is going below the total cost line. So, again you have the loss region, but in between you have the profit region which is increasing slowly, and it is getting maximum at certain point of time, and then you can have the calculation of the maximum profit in such cases. We will also discuss about we discussed about the applications of these break-even points, and its typical application can be in the cases of stock selling, where while selling as well as purchasing, when they are bought or they are sold at different prices, and then you have commissions which are there in those cases, and these commissions are paid through transactions. So, basically this break-even analysis or concept can be useful to find that point beyond which the investor will basically will be in a position to sell her stocks to make a gain. So, in those cases these break-even analysis are useful, and it is a very good decision making tool when to sell the stocks, so that she can have maximum profit and so. So that we will study. So suppose when we talk about the stock selling, suppose a certain number of stock is is purchased, and at purchase price. So, there will be some purchase price per share, and that we take as x, and you have commission rate. So, basically the commission will be used while purchasing or while selling, and commission is basically commission rate on purchase is IP. So, that is your IP is the rate of commission so IPX basically whatever IP into that amount, that will be your commission for the purchase. So, cost of purchase. So, if you talk about the cost of purchase, now in that case the cost of purchase will be xk plus IP into xk, and so we have per share price is x, and then you are taking the number of k. So, that will be xk, and then IP xk will be your cost of purchase. So, xk will be common, and it will be 1 plus IP. So, this will be your cost of purchase. Similarly, we have the revenue equation, and this will be basically we can write this revenue of stock. So, if these stocks they are sold at certain selling price. So, if you are selling the price these stocks at certain price. So, suppose while selling, while these stocks are sold, now the selling price so per share is y, and again the commission will be there again on the selling. So, if the and commission on selling, so this is commission on selling, that is 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 there. In that case what we have, the revenue will be YK minus. So, in this case whatever revenue will be there, it will be less than what it is actually, because you are paying the commission in this case. So, YK multiplied by commission on the selling. So, it will be YK times 1 minus IS. So, in that case when you talk about the break even point and per share. So, now in this case YB will be the so in that case when you are talking about break even point. Now, at break even point you have the cost of purchase same as cost of revenue. So, if you equate them, it will be x into xk into 1 plus IP will be same as yk into 1 minus is. So, the y break even what should be the selling price, that should be known, and in that case it will be x into 1 plus IP divided by 1 minus is. So, basically it tells you that what should be the you fix these price of the selling price of the share, so that you are coming to a break even position where you will be having the no profit no loss kind of situation when you are putting these commission charges on both the transactions like purchasing of the share or selling of the share. So in those cases you can have the idea of fixing your selling price of the share in such cases. So, in a nutshell, we studied about this break even analysis. This can further be used for many applications. It is also used for the early retirement plans, where many a times you are given certain benefits before retiring. So, in those cases you can have the assessment of those benefits, whereas there will be some losses if you are not continuing with the job. So, in those cases also you can do the analysis and you can have a break even analysis, and that will help you in judging whether you should take premature retirement or not. So in a nutshell, we studied about these break even analysis. Its uses are many. It will evaluate this capacity of firm to cover its operating cost, so that it is able to make the desired profit. So, that is one of the primary use of the break even analysis. Then it will also assess all the ways in which the profit will be relating to the sale, and it will also measure its responsiveness to fluctuation on the sale values. So that way how the sale value will be changing if the price is changing, I mean price is changing, then how the profit will be changing. So that also will be clear by doing this analysis. And it will also be talking about the business risk also. It will be providing you that knowledge of the business risk, and when especially when you are thinking of the variability of investment returns on assets, and also the operating leverage that we will discuss later, where we will see that by selling how much what will be the change in the income and all that. So that analysis, that is also basically idea, that idea is also coming from that analysis. And overall it will also give you an idea whether to launch the possibility of launching a new product, or understanding the business better, because that if you are launching a new product, then how much time it will take, how much units you must be able to sell, so that you are at a stage where you can say that you are neither at profit or not at loss. So that will be these are the different types of uses, because many a times you are over ambitious and you think of starting, you start in the new product in a flick, and that may lead to the losses rather than the profits which you are aiming to generate. So these are the uses of these break even analysis. There may be limitations also. Then one of more important thing which is required to be understood in the case of break even analysis is you may come across this term like sensitivity. So sensitivity of the variables. So we have already discussed that the variables, how they are going to affect this break even quantity. So we have studied that there are many parameters which are important, and how they are going to change, the break even point or break even quantity. These variables are like, you have seen that when we define the break even quantity, it is FC by V minus P minus V. So you have fixed cost, and then you have variable cost per unit, then you have price per unit, then you have marginal cost. So that is margin of contribution. So contribution margin which you got, which you define. So all these things have some say. Fixed cost, if it is increasing, then the break even quantity and break even revenue, so break even quantity will be more. So, in that case, then if the variable cost per unit is increasing, so that way also your break even quantity will be more. Similarly, and so break even revenue will also be more. Then price per unit, if you are increasing, in that case your revenue will be more. So, in that case, price per unit increasing, the break even revenue will be less and your break even quantity will also be less. Contribution margin, if it is increasing, in that case the break even quantity will be decreasing and break even revenue will be decreasing. So, these are the this is known as sensitivity analysis, where we try to see the effect of the variables on certain output and how they are affecting these values. So, that is known as the sensitivity analysis of these variables on the B, Q and BER. So, that should be clear into your mind, and that can be when you are solving the problems, you can see that how they are changing, how with the change of one of the parameter other things are how changed. So, that can be understood. Thank you very much.